Welcome to the Investor Agent Podcast. I'm Steve Seymour, your host, where we help transform the human mindset from scarcity and lack to abundance and wealth, one conversation at a time. Hey guys, Steve Seymour here with the Investors Agent Podcast. I have Trevor Calton on. Trevor, thanks for being on the show today.
Hey Steve, thanks for having me. I appreciate it. It's nice to be here.
So we're going to dive right in. I want to get a little bit of background on you, Trevor. I know you've been training real estate brokers in the world of multifamily and commercial real estate investing for, I believe you said 18 plus years.
Mm-hmm.
So why don't you give us a little background on how you got into all this?
I feel like I was destined for being in commercial real estate. When I was young, I thought I wanted to be an architect because I grew up in Los Angeles and I was always going around checking out the big buildings. And I think probably somewhere around middle school, I figured out I couldn't draw, but I was pretty good at math. And when I was in college, I was a business major and studying real estate. And I majored in finance because I knew that if I wanted to be in commercial real estate, I needed to learn how to run numbers. And so when I got out of undergrad, I decided to go working for a mortgage bank. And I live in Portland, Oregon, and there was a rapidly growing mortgage bank here in town that was doing quite a bit of acquisitions of distressed assets around the country. So they were buying pools of loans from banks and foreclosed commercial properties. And I got a job on the acquisitions team as a due diligence analyst. So my first couple years out of college were flying around the country, going from bank to bank and underwriting distressed commercial properties, everything from hotels.
What an amazing experience to get so early on in your career.
It was awesome. I learned a lot. I got to see every kind of prototype. Yep. And as an analyst,
that's like 0 to 100 to some people, I would think.
Yeah. Well, I went after it. It was something I knew that I wanted to do. I really wanted to learn. I just happened to be lucky enough to find myself in a place that if you were willing to work hard, they would give you as much responsibility as you could handle. And it was a lot of fun.
It's amazing.
Yeah.
So what was next?
After a few years,
Yeah.
Yeah. After a few years as an analyst, I learned about the finance. I learned about the real estate, and I wanted to get out on the deal making side. And making more money, frankly, because I was on salary. And I used to see a lot of these brokers and other guys, doing really well. And I went to go get, I interviewed as a commercial mortgage broker in 2004. And I was talking to the owner of the company, and he says to me, well, I just filled my last mortgage desk yesterday, but I could really use a real estate broker that speaks finance. And at first I was like, no, I'm not interested. And I remember he said to me, well, I can understand that, it's a lot harder, even though you can make a lot more money, and kind of roped me in. And he was right.
Kind of reverse negative sale. He was like,
yeah. And he was correct, because my first year as a broker, out of 31 agents, I ended up being top producer, and I crushed it. I did like $15 million in transactions my rookie year. And so I realized then that he wasn't kidding. The finance really matters, and being able to sit down with a client and walk them through the numbers and explain to them, the impact of different leverage options, or a variety of things, negotiating. It's in commercial real estate and investment properties, it's all finance. We don't get into the business because we want to be landlords. We get into the business as investors. And so understanding the numbers really, really helped. And a year later, I was training all the brokers in the office. So in 2005, that's when I started training real estate agents, everything from the beginning to, the basics, like how to calculate a loan payment, to helping clients who maybe want to roll up a bunch of smaller properties and go into one big commercial property. All of that. It's all financial analysis. So that's how I got here. And then, years later, I was teaching at the university. I was teaching real estate finance, and my students were like, hey, Trevor, you need to put some of these on video. And over the course of a few years, I figured out a way to make the finance actually watchable. And that's how Real Estate Finance Academy was born.
So make it in a way that doesn't put people to sleep, right? And
That's
understandable.
the goal. Yeah, that's the goal.
Bite sizes that they can chew on. So, yes, I mean, finance is a huge piece of the puzzle in real estate investing. And without it, you can really make some very poor decisions. So with that, and with all your experience, what do you find that are some of the biggest three, like I would say maybe the three biggest mistakes you see people overlooking when they're evaluating properties in terms of the financial aspect? What are some of the biggest mistakes, the things that you see that is pretty common among real estate investors?
Steve, that's a great question. The first mistake that I see probably most often is the assumption that LTV is the amount of financing that you're going to be able to get. People call me all the time, or brokers are saying this guy wants 80% LTV, and I think what that demonstrates is the main difference between residential and commercial is that LTV is just one constraint, but that's not actually how the financing and the loan size gets determined. It's the income and the debt service coverage, which changes with the loan terms. So the amount of financing that is available on a commercial property is directly related to the income on the property. And just because somebody says, oh, we'll go up to 80% LTV, doesn't mean that you're going to get 80 LTV. And I think that's the biggest thing. So it's a little bit of a shock when people who are maybe just breaking into commercial come to us and say, hey, I want to buy this $2 million property and I only want to put $400,000 down. What can you do? And what's the rate? Now lead me into the second thing, which is, this happens all the time. People will say, well, what's your interest rate on a multifamily? And I always say, if somebody answers that question with a number and they don't caveat it, then they're probably making it up, because
it should be the attorney answer, right? It depends.
It depends. How long do you want that rate fixed for? How much are you going to put down? Do you want 25 or 30-year amortization? Do you want to get an interest-only period in the beginning? There's so many different moving parts in a commercial loan, and all of those affect the rate.
So let's go back to what you just mentioned about the debt service coverage ratio and the LTV. So let's break down an example of that in first grade level. So, any listeners kind of get this, because it is a huge piece of the pie with commercial financing. And, you mentioned that it's going to be limited to the income of the property and what that income can cover in terms of the debt that you're going to place on it, regardless of the LTV. So the LTV is kind of the minimum standard, right? And then meaning you're not going to go above the 80% LTV with a commercial lender typically.
Right.
A lot of them are even at 75%, depending on what the risk tolerance is.
The LTV represents the ceiling, like the maximum.
Yep.
I have a couple videos. Go ahead.
No, I was just going to say, can you give like a basic example if you just use some round numbers in terms of maxing out the LTV, and then kind of what do you see as like the typical debt service coverage ratio? I know it depends on the loan and the bank and all of that, but if you could give some ranges.
Sure. The easiest way to think about how loan sizing works in relation to debt service coverage would be, let's say you have a property that's got a net operating income of $125,000, right? And you'll see why I'm using this number as an example. Your typical debt service coverage ratio for most lenders is around 1.25. And what that means is the net operating income needs to be 1.25 times the loan payments for the year. And the one thing that people often don't realize is, in order to actually calculate that on your own, you need to understand how to calculate a loan payment with a financial calculator. So sometimes people want to use that number and they can't, because it's sort of a level 2 skill. But going back to my example, if we have $125,000 of net operating income, 1.25 is the debt service coverage. That means $100,000 is the total amount that the lender is going to allow to for loan payments. And so what they do is they'll take that 100,000 divided by 12, plug that in as your maximum monthly loan payment. And then they say, okay, what are today's market rates? What's the amortization? And they'll use that maximum payment to back into the loan amount. So it's actually working backwards from the income rather than from like the ceiling. And so if we take that, okay, I've got 125,000 of income. The bank says I can only use 100,000 for loan payments because they want you to have that extra 25% cushion. Then you figure out the loan amount, and as long as that's within the LTV, still under that 75 or 80% LTV, then that's going to be the loan amount. So the thing about commercial loans is there's multiple constraints, but it's all driven by the income. And that is really it's a risk mitigator for the lender, but it also ensures that the borrower or the owner doesn't get over their head and overextended, and then all of a sudden they're running out of cash right out of the gate.
It shows the lender that the rent will exceed the income or exceed the debt coverage, and there's going to be some room there for a little bit of error. In terms of calculating the NOI, right, because that's a big piece of it, what are some of the things that you find people maybe underestimate or don't calculate correctly? And then because the biggest thing is everyone wants to save time, right? You don't want to spend a lot of time, put money on down on a deposit and go through due diligence. And, you're taking the pro forma from maybe a real estate broker, and they're being a little aggressive with some things to paint a picture that it's a better deal than it really is. So in terms of actually trying to calculate the true NOI, where are some of the holes that you see that a lot of people overlook or need to be a little more conservative on?
That's another good question, Steve. The thing that a lot of people don't look at is how the property would be managed if it were owned by a third party. And that's the way a lender is going to look at it, is what is the net operating income going to look like, and what are my expenses going to look like if I have to have somebody else professionally manage, if I'm doing all of the regular maintenance, if I'm putting reserves away for turnover and for capital items. And I think reserves are probably the one that get overlooked the most, but the
reserves for CapEx.
Yes. Yeah. So we'll stick with the multifamily example. You're going to have property taxes, you're going to have insurance, you're going to have your repairs and maintenance, your landscaping, but there's always going to be some level of turnover during the year. I think the average multifamily property turns over somewhere between 40 and 60% of its units every year. So if you say you're going to have $250 of turnover costs for each turnover, you really want to be including that in your operating expenses, because everybody else is going to, as far as the lender and the underwriter. And then if you're going to have ongoing capital needs throughout the life of the project, you should be putting away something every month and every year for those capital needs. And the CapEx is a little bit subjective. Not everyone includes capital reserves as part of their operating expenses, but better to be safe than sorry, right? So I think those would be the ones that are most.
Nothing lasts forever in terms of these buildings.
Right.
And they call it, there's a reason why everything has a depreciable life, and the IRS allows you to depreciate it, is because they know there is a lifespan for a roof. There is a lifespan for, these major items in a property. And if you're not accounting for it, then it's going to eventually need to be replaced. So yeah, and I've noticed that even on like the smaller single families, it's like when you look at gross cash flow, you're not putting away for those things. A heater, a roof, any of those things can wipe out your cash flow for years.
Yep.
If you're not accounting for it.
Yeah. I always recommend people take it, you don't want to get into a property and put every penny that you have down going into it. So I always recommend people take at least, well, I guess it depends on the deal, but take some percentage of cash and put that into a reserve fund, get that reserve fund started. I've been in that my very first rental property. Immediately, we were in the negative because we had unanticipated capital needs and we had management issues. So it was a total nightmare, but it was a good learning experience. And you're absolutely right. You want to be planning for that because it's not a matter of if it's going to happen; it's a matter of when.
Yeah. So the big things I heard out of that is, if someone has a property listed for sale or you're evaluating a pro forma and you see, maybe the management fees are low because it's self-managed, you have to look at it as what would it be like if you had a third-party manager, because that's how the banks are going to underwrite it. Right. And then
absolutely.
And if there's no CapEx in there, there should be something. Probably depends on the age of the building and multiple different factors as to what that is in terms of a percentage. But if you don't have those things in, you're being unrealistic.
Yep. And you see that a lot with owner managers. And that leads to another thing that gets overlooked, which is property management.
I'm guilty right here.
Yeah.
I'm actually going through this right now where I'm actually looking at getting a second line of credit. I have a commercial lender that's willing to do a line of credit on some of my rentals in second position, that they're a first position lien holder. And they'll go up to the 75% LTV and they're at 1.2 coverage ratio. And that's where we're running into it. Just on 4 properties, there's, $1 million in equity. And they'll, so the equity's there, the LTV is not an issue. It's the debt coverage ratio that's limiting, trying to get like a $500,000 line. So it's similar.
It's a very common problem when you're trying to scale a portfolio of single family properties. A lot of my clients have at some point or another in their investing career been at that spot where like, I can't get any more conventional loans, and I'm limited to 10 residential loans in my name, and getting a name in, like an LLC is a little bit harder, but still, if you're the guarantor, it becomes harder and harder to scale. And what happens is you see more and more of that trapped equity. So that's a common problem that you're running into.
Yeah, that's the thing, right? Because if you can keep deploying capital and, even if you're finding great deals and creating some equity, value add situation, if you're not able to access that capital that you leave in the deal, you're very limited as to what you can do unless you bring in some private money and, start getting creative with potentially putting together, private money and institutional money as a blended capital stack. And, how do you see where a lot of people kind of have this fixed mindset that there's one way to do things? And obviously like everyone has different risk tolerances in terms of leverage and what you should and shouldn't do. But do you have any tips for anyone that's kind of in that boat where they're not a newbie investor, they have a portfolio, they're looking to scale up, but it's gaining that momentum without essentially running out of capital, how to put deals together where you can almost have that rinse and repeat strategy. I know that's kind of a broad question. I don't know if you have an answer for it, but I think that's one thing that a lot of people, they get into a couple of deals and they have to stop.
Yeah.
Unless they get
it's a great question because it's a really common problem to have. So I bet a lot of your audience can resonate with that question. And I'll tell you a story. I had a client back up in 2007, leading up to the crisis of 2008, and he had 18 different properties ranging from single family to a few duplexes and triplexes. And he was just spread thin, but he couldn't get any more loans. He wanted to consolidate, but he was going to be facing a lot of capital gains taxes if he tried to sell a bunch of things off one at a time and couldn't 1031. And he did a two-pronged strategy, which I think is what a lot of people will run into. The first thing he did is we ended up selling all 18 of his properties, and we were able to roll them all into the same 1031 exchange, but that took a lot more work than most people want to put in. But selling them off even in chunks and kind of dictating the terms of sale so you can roll those into a 1031 collect all of that equity and then put that into a commercial building. That's one way to do it. And I highly recommend people do that, because you mentioned about risk. Generally speaking, 20 units of multifamily is going to be easier and less risky and more profitable than 20 single family properties. And you get the economies of scale. But going back to answer your question, the other way to do that, if you are wanting to roll up and consolidate and get into commercial, especially if you found that scaling has gotten really challenging, is if you're at the point where you have the ability to scale, that typically means you have a track record. And so then you're a great candidate to become a syndicator. And when I say syndicator, syndicators can come in all shapes and sizes, but really just think friends and family, right? If you are a real estate investor and you've built up a portfolio of smaller properties, that might be a great time for you to go out to your network and say, I'm taking this to the next level. I have an opportunity to bring on some partners. Would you like to get in on this together? And then now suddenly you're not relying from point A to point B on your equity in your previous properties. Perhaps you can go bring on some investors and then sell your other properties and reinvest them. Maybe, you can consolidate in a different way. So the true answer is it depends on each individual investor strategy, what their portfolio looks like, but there are options out there.
Yeah. And syndication being simply put as putting together multiple investors into one deal, right? Yep. And then that can be structured so many different ways.
I think people
that is a strategy that, unless someone's familiar with, and I mean, syndication's become pretty big publicly out there. I mean, it's been around for a long time, but definitely with bigger pockets, and syndication has expanded a lot over the past few years, especially with multifamily being such a hot topic. With someone getting started in syndication, I mean, I know you probably have that as part of your trainings and coaching that you do. What are some of the biggest things that you find that people don't set up their syndications correctly, where they're not really looking at how it's going to impact the investor's capital, and then making sure, I mean, obviously if the deal works, kind of everyone's happy, right? But when people are, speculating on rent growth and over the past couple of years, like how it has been in certain markets, I know there's definitely some syndicators that out there that probably have gotten themselves in trouble, where they've taken on bridge loans where the interest rate was at a 4.5% or 5%, and now they are looking at their permanent finance could be 6 or 7, right? So other than those two major things, with rent growth's not really keeping up with, I'm not saying keeping up, I know there's rent growth in certain markets, but a lot of people were showing rent growth of 20% year over year, which is crazy, right? It's like it's unrealistic to imagine that that's going to always continue. Right.
So great question. And there are a few answers there. And the first one I would say is less is more. If you have a track record, the investors out there that want to invest with you are looking for you. And a lot of investors that are, a lot of investors that are syndicating for the first time. And again, when I say syndicating, I just mean friends and family to start, because that's really what it is. You don't want to be syndicating to a bunch of strangers if you've never done that before. You got security
violating
to deal with.
Yeah, you could be violating some.
And I learned this when I did my first syndication. We had 12 partners, and a few of them wanted to be in the deal, but I had one guy that was in the deal for like 12 grand, and we were buying a 22 unit property, and I didn't need that, but I brought him in as a favor, and I didn't, in retrospect, it was just that much more to deal with in terms of the number of reports you have to send out, and the number of questions you have to answer. And actually the smaller investors tend to ask more questions. But my point is, find the the few investors that already understand why your track record is meaningful and recognize the fact that they're looking for you. They are looking for a place to deploy some of their capital. So don't have the mindset that like, oh, I'm out begging for money. You are creating an opportunity for those investors to put their money into something without having to put their time, energy, and resources into it. And so it's sort of a mindset like, hey, I'm scaling my portfolio. I'm about to create some more opportunities. I'm looking for a select few people and to give them an opportunity, and I'm going to bring them on board. So rather than just trying to go out and get a few bucks here, a few bucks there from anybody that you can, you want to really position yourself as confident and creating an opportunity for them. And it's got to be people you know. Don't try and syndicate with people that you don't know, because you're going to end up pitching 10 times more people than you need to be, and you're going to run into all of these securities laws that you don't want to mess with, because they're only getting more and more strict, despite what we see with the Jobs Act from 2008 and the crowdfunding and all that stuff. It's very, very dangerous to get involved in syndicating with people that you don't know. But you can get ahead of that by starting early. And even if you know next year I'm going to want to bring on some investors for a deal, start telling them about it now. And that's another thing that I think people probably should hear is, even if you don't have the deal yet, you should be pitching the strategy, because investors are going to want to know that you know exactly what type of property you're going after. Are you going after value add? Are you going after some repositioning? Whatever it is, whatever your specialty is, understand that strategy, be laser focused on it, because that's when you're going to get investors who are like, you're the person I want to invest with, because you know exactly what you're going after. You're not just anything that comes your way. Does that make sense?
Yeah, absolutely. With syndications, there's a lot of people, a lot of what I heard was, kind of start small, start with people, have a substantive business relationship. So you're not, soliciting and offering, kind of what's in my mind, because I've looked into this as well and done some smaller syndications myself. Actually negotiating one right now for it's a commercial development, smaller commercial development deal. It just would be like 4 partners, but all have previous business relationships. There was no offerings. They actually brought us the deal. It was kind of interesting how it's working out, but we'll see where it goes. And so what you're saying rings true with my experience, because I scaled up with, single families, and it's like, you can do the burst strategy as many times as you want, and it's great as long as you're creating enough equity on the value add, and that's a rinse and repeat. It's a great strategy. But when you get into these larger commercial deals, sometimes the project timeline might take 2 or 3 years before you're really able to access that capital back, to refi or sell or whatever the exit strategy is. So I think syndication is a great strategy to be able to bring in outside money to continue to scale your portfolio.
Yes, and structure the partnership or the LLC such that everybody's interests are aligned. And that goes back to your first question. Some things that that I would recommend would be structuring the deal so that a good portion of the syndicator or the sponsor's compensation comes from performance. Probably the biggest complaint that a lot of investors have, and the biggest cause of redemptions, is the syndicator makes a ton of money on acquisition fees and maybe a bunch of money up front, and it's not very much tied to performance. The hurdles aren't well defined, and the promote isn't well defined. And then people say, well, I want out of this deal. If your interests are aligned with your investors, you're less likely to have people want to redeem, even in bad times. And then make sure everybody understands you're in this deal for 5 years or 3 years or whatever we decide our minimum holding period is. And then after, say, like the way we would structure ours was, I think it was for a 7-year potential hold, after 4 years, anyone could call for a vote and to sell the property. If somebody wanted out and they couldn't sell their interest to another member, anybody could call for a vote, and then majority rules. But after 7 years, anyone could call a force the sale. So you knew that you had an exit at some point, but the syndicator, the sponsor, knew that they at least had everybody's money in for a certain amount of time, and they didn't have to worry about there being early redemptions. And the investors didn't have to worry that, oh, this syndicator is milking all the money out of the property, because a lot of his compensation is tied to performance. So I would just say, make sure that you treat the investment the same way that you would as an investor. Like you want it to be well managed.
Kind of going back to the golden rule, treat the investor how you'd want to be treated. Even if you're taking a passive role in it, you put money in something, you want to have some level of, I know I'm going to get my money back at some point. I'm going to have some trigger to say, all right, guys, it's time to pull the cash back out. Let's, where you're not, and have the performance tied to, if they're taking the active role, that the active role is creating value, not just, like you said, just the fee, the finder's fee up front, the acquisition fees. So I guess let's shift to the other side of that. If you're on the investor side and you want to passively deploy capital into some real estate investments and take advantage of the depreciation, the equity upside, the cash flow, appreciation, all the benefits of investing in real estate without the headache, and you're vetting syndicators, you're vetting operators who are putting together these strategies, what do you think are some of the top things they should be looking at? I mean, I know kind of goes back to the question, right? It ties into exactly what you're saying, but just shifting it from not just how to structure, but how do you evaluate it if you're on the other side of it?
Yeah, that's an excellent question.
I'm going to just keep soaking in as much as I can from you,
Yeah, let's do it. And I did exactly that when I started syndicating. I interviewed 20 different syndicators before I put together my first deal. And the one thing I would ask them is, what is your reinvestment rate? Like you want to, if you, as an investor, you want to invest with somebody that has some level of experience, and it doesn't necessarily have to be their very first, or they don't have to have experience in that, maybe a property type. Like if they're going to go to big multifamily when they were doing smaller multifamily, that's okay. But you want to make sure that they have at least done deals before and have a track record. And if they have multiple deals, how many of their investors reinvested with them again? That is a good indicator of, performance. And it's okay to ask for references. I think it's more than okay. It's probably necessary. I would want to know how their promote is structured. And so what are they taking for acquisition fees and asset management fees, and what other fees are they taking? And how are those cash flows paid out in terms of like priority? The other thing that I would say is, if you're an investor and you're going to go invest with a syndicator, it should be a property type that you believe in and that you're comfortable with. So if you don't have any experience in, say, medical industrial or something, you may not want to be investing in that, because then they're going to start speaking a language you don't understand. And there's going to be a lot of mechanics, maybe in like the leasing process or the tenant improvement process, that you just don't understand. So I would say invest in a property type that you understand, and a sponsor that you believe in, and make sure that sponsor, his interests are aligned with yours. So I think there's a lot of trusting your gut. You can just kind of tell when people are really going to work hard for you as an investor and they really want to make it succeed. And nothing is a better indicator than when their compensation is tied to the performance of the asset.
It's the difference of an employee mindset versus an owner, right? It's like someone, they're going to only get paid if they perform, if they make it happen.
Yeah.
Now, I know there's so many different structures of syndication, and some are, GP, LP structures where the general partner is, I'm just kind of general terms, they're the operator, right? They're the ones taking an active role in the business and creating the value and typically bringing the deal. And then there's the LP side. Let's just for conversation's sake, just say the limited partners taking a passive role, investing their capital into the deal. And that's really the only value they're bringing. It's just the capital, right? In every deal that makes money, there's different levels of value that are brought to that transaction. So have you ever really tried to see like what the breakdown of that should be? And I know, again, it's like you can look in generalities, but there's never, 100% rule for any one thing, because, if someone brings the deal, there's value. If someone puts together the institutional money, there's value. There's value to actually handle the, let's say, project management, construction management. And then you also have like kind of the asset management piece, right? And then you have the back end of the business, which is all the other things, the administrative, the accounting, the, all the day-to-day, making sure the property is properly insured and everything, right? So there's all these different components. And it's like, have you ever like broken down what you feel like each valuation or each segment is valued at, so that when you put together a deal, depending if there's different partners, you are, kind of setting the stage for the most fair compensation based upon roles. And I think that's something when people are putting together syndications, a lot of times it's not just one person that's taking an active role in the business. It's a lot of times it's a team sport.
Absolutely.
And I think a lot of people get stuck on like, what is the allocation for each thing and who should get what. And I mean, I know that's pretty deep, but I think it's something that a lot of people need to think through, because you're putting together a complex structure. And the more people, the more complexity is, and the more different components of the deal. So, do you ever put like, oh, maybe the project management should be,
Sure.
15 or 20% allocated towards that, 5 to 10% for the deal based upon how great the deal is.
I have a simple answer for that, and do it the way a lender would do it, and treat every function as if you had to outsource it. Okay. So if you had to pay an asset manager, third-party asset manager, you'd probably be paying them 1 to 1.5% of the gross. If you had to pay somebody to bring the financing, and you'd probably be paying them 1 to 1.5 points on that financing piece, or more if it's equity. But what I would say, and the way we do it, and this keeps it really simple from a math perspective, and if you had to unwind an investment because it went south, the simplest answer is the easiest, which is treat everybody's money pari passu, right? Every dollar that goes in is treated the same, regardless of whose dollar it was. And then when people are playing a management role, if they're not purely passive investors, then they should be compensated for that role as if you had to outsource it. Because at any given point, that partner could say, you know what, we're going to go live on the beach on another continent. Somebody else needs to take that over. And either another person's going to have to absorb those responsibilities, or you're going to have to outsource it anyway. So it shouldn't impact the investment. And that way, there's going to be less debate on the value that is brought to the table that way. And
there's
then
some evidence, right? There's some evidence that this is the market rate for, originating a loan, or this is the market rate for if someone was bringing a deal to the table and they were getting an acquisition fee.
Absolutely.
Project management.
And then you can share those particular functions. Let's say if 2 people are working on the acquisitions and there's 4 people in the investment, the other 2 are completely left out of that function. And then there's an acquisition fee, and those 4 people can agree that the 2 people who are working on the acquisition can share that fee. But especially when it comes to things like asset management and ongoing roles, just treat it as if you had to outsource it. And then you can put a number behind it, and then it makes everything seamless.
Yeah, that's a great answer. And in line with what I was thinking, it's one thing to try to figure out who's really good at what, and who should sit in what seat. But if you kind of take the people out of the equation and just look at the function, and then what is the market rate for that, and
yes,
then
exactly,
create a percentage, and that way it kind of depersonalizes it a little bit, right?
Mm-hmm.
In a negotiation between a partnership. So really good stuff. So do you mind if we shift a little bit towards, today's market, where things are heading, pull out your crystal ball? And
Yeah,
I'm not going to ask you to make any predictions, but if you could make some possible guesses or assumptions, I'd love them. And, maybe specifically around, let's talk mostly about the multifamily space, because I think it was such a hot thing over the past few years. And over the past, it always has been, but there's definitely like a big buzz around multifamily. And one thing for me getting into this space, I'm like, how are people paying over the past few years? Like, why are you buying this thing at a 4 cap? And they're like, I don't care about the cap rate. It's a value add, right? It's like, okay, well, I understand that to a degree, but if you're financing it, the deal's kind of got to work now versus speculating on what you're going to be able to do with rent growth and, improvements. And obviously there's evidence there, but do you feel that there could be some people that maybe bought at prices that they were anticipating they weren't anticipating the rates going up, and they were maybe anticipating larger rent growth than they've seen? I'm not seeing any major distress out there. I've talked to different people, but I know there's got to be some level of disruption in that space from where it was.
absolutely. And a lot of the things that you just touched on can be mitigated with proper analysis and due diligence. But when we were looking at acquisitions 5 years ago, I basically put pencils down because we knew that cap rates were at an all-time low, financing was at an all-time low, and really it was just like the perfect market conditions for a gold rush. And now what we're seeing, we knew that rates would go up because we knew inflation was going to go up after the pandemic when they printed all that currency, and that part everybody knew was going to happen. I think the one thing a lot of us underestimated was the rate at which the Fed increased the cost of funds.
Yeah, so it was acceleration. It was like a roller coaster.
Yeah, and so it's a little bit more jarring than any of us expected. But I've been going to some conferences. I actually just heard a great speaker recently. He's Spencer Levy. He's the head global strategist for CBRE, and he did a great presentation talking about the fundamentals. And I agree with a lot of the things he said. And effectively what he said is we're probably at the bottom of the market right now in terms of market conditions, because rates have just shot up. Cap rates haven't followed interest rates, which they always do, but they always lag. And so we're just now seeing sellers get a little bit more realistic about the cap rate that they can exit at. And that touches on what you said in the beginning, which is if you bought at a 4 cap and you didn't anticipate exiting in the 4 to 5 cap, then you're probably panicking right now, especially if you've got an impending refinance coming up. So again, it depends on the strategy, but I will say that all the indicators are that the rate of interest rate hikes is leveling off, and cap rates are doing what they always do. They're following. So that disparity between cap rates and interest rates is starting to level off and close. And we'll be back into areas of positive leverage again. And I'm seeing that. But for the past 9 months, we haven't seen any positive leverage. The cost of funds was greater than the cap rates. And I have videos on all of this stuff. For those people that don't follow what I'm talking about, when your cost of funds is greater than the income that's coming off the property, then you're paying more to the bank than you're getting off
and that's
the
where
investment.
I was like, why is this multifamily thing so great? Evaluating deals over the past year. It's been interesting.
Yeah.
It is great. It can be.
I'm quoting deals right now for clients we're quoting retail deals more again, and it's starting to come back down. And I told my clients last summer, I said, you guys might be the last loan that I ever do or my team does that's below 5%. And I honestly believed that. And we knew rates were going to go up, and boy, did they. But the nice thing is right now we're quoting rates in the low 5s on multifamily similar properties. And that's really encouraging. So cap rates
difference. Yeah.
Say again.
It's not extremely different then, now
Yeah.
things are coming back down. But like you said, there's a lag period, right? Or do you think that now that the rates are dropping, then it kind of changes the mindset of the seller as well to just say, I'll hold off?
I don't think rates are going to come back down to where they were.
No.
They might, but I think we're going to be back. We're going to be probably where we were in a 4% world for commercial for a long time. I think we're going to be in a 5% world for a while. And maybe I'm wrong. Eventually, I will be wrong. So it depends on the time frame.
That's way better than when it was at 7 or 6.5.
Yeah. And historically, prior to 2009, it was always in the 7s. I mean, we were paying 7 and 8% on every multifamily loan. So it's been really favorable. And so if you look at the grand scheme, things are still really good, but it's that disparity between cap rates and interest rates that really messes things up. And that's where those syndicators are going to be in trouble. If they don't have an extension option on their loan and they have to refinance or sell and they can't get out, those are the ones that are going to be in trouble. But my clients don't have that issue because I wouldn't let them get in that situation in the first place. We're going to build in those things because my team can help you anticipate, okay, what's your holding period? Well, what's the worst case scenario? Well, if you have a value add strategy and it's going to be capital intensive, we're going to put you into interest only for a couple of years, and then we're going to give you the flexibility to deal with things if they go sideways. So our clients aren't running into that, but I know there are a lot of people out there that are, because you hear it in the media and you alluded to it. So my experience back in special servicing in a long time ago would tell you that just remember that in commercial real estate and commercial lending, a lot of things are negotiable, because the one thing I will tell you is that banks don't want the property back. They do not want to foreclose. They don't want you to default. And so if somebody is, say, a novice syndicator and they're running into those issues, there are negotiations out there that can be made. You probably just don't know what they are. And that's, again, where I think my team comes in is, we have a pretty broad array of experience. And so, we're able to help people figure out what their strategy needs to be, because it's different for every investor.
Can we talk about negotiating commercial financing?
Sure.
Because, that's one thing that going from a residential investor initially, let's say someone's buying maybe they're buying their primary, turning it into an investment, 20% down, conventional loan. Generally, it's more like shopping rate and fees, but there's usually not a lot of negotiation because they're packaging these loans up, selling them to Fannie or Freddie.
Absolutely.
With the commercial debt, is it kind of like the Wild Wild West in a sense?
Relative to residential, absolutely, because almost every residential loan gets pooled and sold off, and that's why there's not a lot of flexibility. But we do this all the time. You can tailor a commercial loan to your strategy, and everything is negotiable. And there are far more levers and pulleys in a commercial loan than residential. And I'll give you an example, like I just alluded to. Let's say if you're an investor that is doing a value add, right now it's pretty easy to get your first couple of years payments as interest only, which, in today's market would cut your payment by a third. It's going to make it a little bit more expensive. You might add 10 or 20 basis points to your overall rate, but you can pay to play however you want in commercial loans. So you can typically get a 3, 5, 7, 10, 15, up to 35-year loan with a fixed rate. You can get a 20-year loan with 10 years of it fixed. We can do 20 years, 10 years fixed, 2 years interest only at the beginning. And all of those things are negotiable. Things like the prepayment penalty, that's negotiable. And that's why it's really important. And this is part of what drives my business is, one, educating the investor. Because the more educated you are, the better you can tell the quality of the advice you're getting from your professionals. And as an investor, if the advisors you're using are not asking you questions about your holistic strategy, the rest of your portfolio, who are the stakeholders, there should be a long list of questions that your advisors are asking you, so that you're getting advice that really fits your strategy. And I think that's where we are able to differentiate ourselves. And you see it because most of our clients don't run into trouble. And I love it because I get a lot more thank yous from my clients. Who are like, you said this was going to happen, and it did. Thanks for helping me know that, because a lot of times if somebody is giving you advice, but it's limited and then they leave a bunch of things out, you don't know it. So
let me recap some of these levers and tell me if I'm missing a few, because I'm sure I am. You have your amortization, right? Because it could be, some commercial lenders might be saying, oh, we do a 20-year amortization. One lever to get within the debt coverage ratio could be 25, right? Spread it out. That could be a negotiation point. 25, 30.
absolutely.
One could be, you said the prepayment penalty, maybe they have like a 5, 4, 3, 2, 1, and maybe you go back and offer a 3, 2, 1 or something like that.
Yes, yes. And, or, a lot of people get into, and they don't, a lot of people get into loans and don't even realize that there are different kinds of prepayment penalties, like yield maintenance or defeasance versus step down. And yes, you can negotiate the prepayment penalty. If you think you might want to get out in 3 years and it's got a 5-year prepay, you could probably pay a few extra basis points in your rate. But Steve, let me tell you this. For most of us, as you grow, you shouldn't be shopping for your own commercial loans.
No.
You're not fixing your own toilets. And if you're scaling your portfolio and you're still fixing your own toilets, you're not using your time wisely. And this is a huge lesson for investors that used to be in residential and are graduating up into commercial. You should not be shopping for your own commercial loans. That's what the brokers are for. And it's different than maybe brokers like this in, say, like a real estate broker. The commercial lending market, it's so fluid. It changes every week. The guidelines change. There's literally no advantage to trying to go out and shop for your own commercial loan, because the commercial mortgage brokers, they talk to the lenders all the time, every day, in and out. They know the programs. They know who's expanding, who wants to get more aggressive, and you're going to pay the same amount, because typically the lenders will waive or reduce their origination fee so the broker can charge a fee. So the economics don't change. It's sort of like, you're going to pay for your lawyer if you go to court. Why would you not get a lawyer, right? You're not going to go represent yourself if you're paying for it anyway. You should have a lawyer. The same thing goes with the commercial capital markets. And that goes back to your question. So how do you know what to negotiate? That's where you need to have good advisors. But prepayment penalty is one of them. There's all kinds of things. I mean, I should probably do a video on a list of all the different things you can negotiate in a commercial loan, but I think it'd be a long list.
Yeah, and every lender, right? Some are going to bend on certain things and some won't, just because they might not change their box too much. But that's cool. A lot of people you just don't think you could potentially negotiate your loan terms, and in the commercial world, you can.
Almost everything's negotiable in a commercial loan. And again, it depends on where that loan is coming from, because as you get into larger loans, like a CMBS loan, where it's already destined to go into a mortgage-backed security, you're going to have less flexibility than you would, say, like a portfolio lender with a regional bank. They're not selling that loan. They're keeping it on the books. And once it becomes a loan, it's just effectively a bond for them. And so as long as they know what their risk exposure is and what they're going to get, they're usually going to be pretty flexible about certain things that don't really impact them. Where if the loan is going to be sold, changes to the terms impact their ability to exit. So that's another thing that we advise people on is, again, what's your strategy? How long are you going to hold this for? And I always start out when I'm talking to an investor or who I think is going to become a lending client, like, what are your goals? Let's talk about your strategy first, because especially can't quote you a rate until I understand, well, what kind of loan do you want? If you want to do a value add and you want to get out of this thing in 3 to 5 years, then that tells me one group of loans that are going to be not a factor, and another type of loan that's going to be probably a better bet for you. So you kind of got to narrow down all of your options based on the goals of the investor before you make a decision on what kind of loan you're going to get. And that's why I always tell people, although you can't pre-qualify or get pre-approved for a commercial loan, you should be able to define your strategy beforehand and know what you're going after.
Yeah. With the not getting pre-approved for a commercial loan, one thing that I've gotten frustrated with in the past is getting loan term sheets from commercial lenders and then getting to closing, and then they're not quite what they stated. So for me, working with commercial lenders, I tell them very clearly up front, don't give me a loan term sheet you guys can't deliver on. I'd rather be padded a little bit and be conservative, because if I'm underwriting a deal, and I know the rates are changing, so it depends on what it is, but I've had multiple times where either the rate changes a little bit, or they have an interest reserve that they didn't put on the loan term sheet that they throw in there, or they'll adjust the LTV down because of their risk tolerance on the deal, something, so I know until it's fully underwritten, but when you're shopping commercial lenders, or your broker is for you, I'm sure you do this as a service for your clients. You're a commercial mortgage broker, correct?
Yes.
Yeah. So in your company's Evergreen Capital Management?
Evergreen Capital Advisors.
I'm sorry, Capital Advisors.
Evergreen,
that makes more sense because you're an advisor.
Yeah, Evergreen.LLC. And we can talk about that at the end, but yeah, so I'll tell you right out of the gate, based on that comment, we have a long list of lenders, and the lenders that honor their term sheets are always at the top. So I know which lenders will take a little bit of a loss just so they don't have to retrade the terms on the client. And I know other bankers that I don't trust at all.
Yeah, because as an investor, you could put yourself in a bad spot, even if they offer you a say 6% or 6.5% rate, and that's what the deal's all underwritten for, in this current environment, and then you get to the table and it's 7.25. Well, you're already through your due diligence period. Your money might be hard now at this point. You might have, you have your appraisal done. Other lenders might not want that appraisal, depending on how it was, how it was conducted, who ordered it.
I'll give you an example that relates to that.
That you kind of have your hands tied at that point. So they'll give you, and sometimes they'll tell you, like, here's your term sheet, but the rates aren't going to be locked in until the day of closing. Or some commercial lenders do 100% honor what they put on there, and others don't. And that's something to know, and the value of having a broker to know that, hey, these people are at the top of my list for a reason. Other people might put some teaser offers out there, but they're not telling you they're going to have all these other requirements.
And that's why I say, if somebody quotes you a rate on the first phone call without asking you questions, that's a red flag. And people, a lot of clients, we lose clients sometimes that get frustrated because I won't quote them a rate without them giving me more information. But then that just tells me that they're less sophisticated and probably going to be more challenging to work with anyway. But you really want the people around you to demonstrate that they are invested in your success. And it's not about just getting this one deal done. It's about you becoming a repeat client, somebody that you trust. There are a lot of people, I love it when they tell me, like, Trevor, you're the only guy I have to call. And I have a team of, and we have 6-7 brokers that work for Evergreen. And a lot of us have repeat clients, and they don't ever call anything but our cell phone. And they know, like, hey, we're going to handle it. And then we're not going to go and just shoot them an interest rate. We're going to call them. We're going to sit down. We're going to talk about, okay, tell me about the deal. Where is it? What's your strategy? How long are you going to hold it? Who else is involved? And then we can say, okay, well, based on what you're telling me, we don't want longer than, say, a 5-year prepayment penalty, or, there's a lot of different things. I had, speaking of prepays, I had a lot of clients I've been talking about, talking out of getting into yield maintenance penalties. If we think rates are going to come back down, which a lot of people do, even a small dip in rate can be a huge prepayment penalty if you have yield maintenance structure versus step down. Most people don't understand what that means, but that's why I say you want your advisors to demonstrate that they're invested in your success, not just say they are.
Can you break down at a high level yield maintenance as a prepayment and kind of the risk with that, especially in this current environment, like you just said, just what does that look like? I don't know if you don't have to give an exact example, but in a general rule.
No, it's conceptually. So in lending, most people don't realize, but prepayment is a privilege. It's not a right. When you sign a promissory note, you sign a contract saying you're going to make a certain number of payments, and that's how your loan is going to get repaid. The lender doesn't want to be paid back early. Just means they have to go and redeploy that capital into a different investment, make a new loan. And so that's why prepayment penalties exist, is they are going to make a little bit extra money if they have to go and redeploy that money again somewhere else. In residential, that's all built in and prepayment penalties aren't allowed. But in commercial, almost every loan has a prepayment penalty. And the step down is pretty easy, right? 5% in the first year, 4% in the second year, 3, 2, 1.
And that's just 5% of the principal balance at the time of the payoff.
Correct.
So,
and yes, 5% of whatever's left,
but the principal will step down as well because it'll pay down, so it'll be reduced.
Assuming you're not paying interest only.
Correct.
Well, a prepayment penalty that's called a step down it's just going to add a couple percent to whatever your payoff is. Mm-hmm. And it's very easy to calculate, very easy to predict. Yield maintenance is a penalty that maintains the yield for the lender. So an example would be if you got a loan at 6% and a couple of years later, you didn't want to pay it off and the rates have dropped to 4%, the lender is going to say, okay, you owe us, let's say $1 million. We were making 6% on that money. Now, if we went to deploy that, we could only make 4%. So you're going to pay us the difference. And not just the difference that year, the difference for the remaining life of the loan.
Life of the loan.
So yield maintenance can be insignificant if rates go up, but if rates go down even just a little bit, yield maintenance can be really, it's just very unpredictable.
Right. Yeah, that's a lot. So first of all, I think probably a lot of this went over many people's heads, but I'm sure there's some listeners that gained some value. I appreciate you diving deep and going into content because a lot of times we talk conceptual mindset. There's some real nuts and bolts in this conversation. So if you didn't get it, you can go back and listen to it again. If it sounded Greek to you, some of the lingo, but hopefully you guys, you can pull out your phone and Google some of these terms. If we're talking about LTV and all the basic terms that, this was not a 101 conversation. Let's say that.
Even better though, my YouTube channel, Real Estate Finance Academy, has a video on everything we talked about today. And
there you go, right there. So you don't even need Google.
Yeah. And I'm glad it helped. If any people have questions, we could always do a Q&A. So if we want to do this again, I'd be happy to.
Absolutely. But I did have a couple more higher level questions, right? So from you, because you have all your knowledge and your experience. I would now want to tap into your wisdom. So knowing what you know now, going back 20 years, 2 decades ago, when you got into this, if you were talking to yourself, what are maybe say the top 3 things that you would have potentially done differently or been more aware of?
Great question. I would have chosen fewer partners with more experience, and because there were a lot of times when I think, I was the most experienced person in the room, and that's okay. But you always say, surround yourself with people that are smarter than you. I feel like I do that all the time, but I would have had more people that I could have leaned on that have been through the ringer a few more times. And I say that in the context of 2009, because that was tough, but it was tough for everybody. And there's just things you couldn't predict. That's one thing. So just really like what you do with even this podcast or just your networking is, surrounding yourself with other people who have really good perspective and some experience that you don't have. And because when things inevitably do turn down, the cycle turns and things get tough, you want people that are going to remind you that it's not the end of the world and help you get through it. And that's, I think, really, really important, because especially if you are syndicating or things like that, where you're the person responsible for other people's money, and then the market does turn. I'm sure a lot of people right out there right now are feeling this way. Like, you can feel alone. You can feel like you're out on an island and the world's coming down on you. And I remember one of the hardest experiences I had could have been solved with 50 grand. But I felt like my life was over. And so that's one thing. The other thing is, if, not necessarily based on my own experience, but I think what I would tell people earlier and often is, don't get stuck in the single family, thing. If you want to scale up, the sooner you scale up, the better, because the one thing that gets really challenging, scaling up into multifamily, gets harder and harder with every single family property you buy. And I'm not saying single family is a bad strategy. I'm just saying, if you know that eventually you want to get into apartments, do it early, even if it's just 5 units. But it gets so much more difficult to roll that equity into new investments when it's scattered amongst smaller properties. So that would be another thing.
Let's tap into number 3. One more thing.
What was the third?
Just one more tip. You gave us 2. One was, partner up, surround yourself with people. I kind of lumped that into one category.
Yeah.
Right. It's kind of like that was like surround yourself with better people, more experience.
Yeah.
Number 2 was get into multifamily sooner than later, because it's not easy, or it's harder to transition once you're spread out over a bunch of single families. And I'm assuming you're saying that because of a 1031 and access to capital and all those things. But
absolutely, yeah. And I would say, if you are, regardless of who you are, if you are spending all of your time working, which I'm guilty of, have been in the past, just don't forget to delegate. Don't forget to just constantly have to be building your team, because if you're a good leader and a good manager, your people are going to leave because you're going to inspire them to do great things for themselves and their families. And just don't forget to live your life along the way. Like, practice that gratitude. Like, spend time with your family. There's all the things on your desk and your to-do list are still going to be there, and you're never going to complete all the things that you have to. And I think a lot of us, especially if, we're motivated and we want to do great things and we want to build a legacy, sometimes we get solely focused on that, and then we forget why we're trying to build that legacy. And we are neglecting the things that actually matter, which is our families, our loved ones, or the community. And so I would say, in the context of, like, personally speaking, I need to be better at delegating. And I'm fortunate that my wife reminds me, like, hey, you're working hard enough. You are doing enough. And don't forget to enjoy it along the way.
Well, I appreciate you sharing that. And that's what I meant by sharing your wisdom. So I'm glad I asked that question. And I'm glad you shared that information. Yeah. Trevor, thank you so much for your time. I know your time is valuable and you charge for this, so I'm very grateful. Thank you. Anyone that's listening, you just got a bunch of Trevor's information, but it's not as in-depth and it's not as broken down systematically as his training courses, so you guys could check them out. Trevor, why don't you share a little bit about your real estate training that you have online?
Yeah, so my online training is a Real Estate Finance Academy, and there's a ton of free videos. I think at least 100 videos on YouTube. And then we've got courses for real estate investors, real estate agents who are getting into multifamily, commercial, and commercial lenders. And then my primary business is Evergreen Capital Advisors, which is easy to find at evergreen.llc. And we do commercial lending. Again, we specialize in multifamily investors. And just so you know, Steve, this is my favorite thing to talk about. So I'll talk about real estate to anybody who will listen. Like, I think you would too. And so I'll come back anytime.
Yeah, there's something wrong with me. I love talking about this stuff.
Yeah. Well, we've got some people have to love it. Might as well be us.
Yeah. I mean, we probably put a couple people to sleep by now, but if you listen through the whole thing, we appreciate your time and attention as well. And, we'll make sure to post Trevor's information below. So thank you very much. And we'll be in touch soon.
Thanks so much, Steve. It was good talking to you. Have a good one.
Thank you for tuning in to the Investor Agent Podcast today. We hope you found it valuable. Please tune in weekly at theinvestoragents.com.